From my experience, I'm going to recommend that you have at least $10,000 in your account in order to day trade, swing trade, or maybe even position trade. Now, before you get all crazy and start writing snarky stuff, which I'm just going to delete anyway, hear me out. I've been there. I started with an underfunded account, and it was really, really hard. So this is coming from experience, not, saying, anything to put a stick in your eye. When I had an underfunded account and I started, it was a few $1,000s. I was adding to it every paycheck, got it up to 5K. And if you remember in an earlier episode, I talked about this, how I was willing to put up to 50% of my cash into one particular name at a time. This included futures and stocks in the same account at the time. The problem is that my timing had to be absolutely impeccable. But even though I was at a wirehouse, as far as trading was concerned, I didn't know my ass from a hole in the ground. So when you're underfunded like that, you really need to have an amazing sense of selection and a really, really good sense of timing, which you don't have. You can certainly develop it, and I'll give you that. And I know there's stories of people out there who started with a few $100. Richard Dennis is one of them. And there's some, penny stockers out there that have done very, very, very well. And my hat's off to you. Like, we're all celebrating the wins here. It's just that I get the emails from the other 19 out of the 20 people who don't make it. And they're like, man, I wish I get this I get this at least once a day. I wish I saw your channel sooner. And that it really makes me sad. It's not something I click my heels about because it's not like I'm trying to save lives here. But what ends up happening is when I had an underfunded account, I had to be highly selective as to where, because I didn't have enough money. You don't have any flexibility. And the last thing you want to do is start to cope and say, I got $1,000, I'm just going to trade the MNQs. That's the worst thing you could do. My hat's off to you for getting in the game, but there's so much more opportunity out there than you're just looking at one particular instrument. And with the $2 point value, what's your goal? Is it just to learn the craft? Okay, perfect. Forget what I said then, because the best way to learn is to trade. I've said that. So I don't mean to speak out of both sides of my mouth, but I wouldn't recommend coming to the market and saying, just be a sugar trader. You'd look at me and say, Mike, you're an idiot. So I wouldn't recommend coming in and trying to trade the MNQs, the NQs, or the E-minis, the ESs either. There's too much opportunity in thousands of other names. But when you're underfunded, you're forced to cope. And the last thing you want to do is make your trading strategy a coping mechanism, right? Because now you're going to force trades. You have to find something. So then what do? You start to downtime with no training. You're looking at 1 minute bars. What? Looking for divergences? Well, that's great for all your hard work. Then what are you doing? Taking your gains at 2 to 1, 3 to 1. So I see those accounts, they end up churning themselves. So you can disagree with me, but I've been there. And that's what happens. 2, your account is so small moves in the underlying instrument can really hurt you. Right? So I had to be hyper. And again, don't forget, I started at a time when stocks traded in eighths. And I would have to pay at least 25 to 50%, at least 25 to 50 cents commission round turn. Right? It was usually 25 cents to buy it long and then another 25 to sell it long. So 50 cents, if I bought a $20 stock, right, I would need it to go to $20.50 just to get out of the trade flat. And whatever gains I had were going to go to pay the commissions and still get a tax bill. So I couldn't focus on these short-term little spurts of activity in the marketplace here. It wasn't going to work for me and move the needle. So that's why I had to grow my account fast. That kind of shaped me. The fact that I was underfunded shaped me to develop really good habits, like add more money to the account, take my losers quickly, add to my winners, take the risk home overnight. Obviously, I'm looking at strongly trended things. I'm not looking for pullbacks. Scalping was stupid. I still think it's not enough money. And I know there's a few people that do it. But if I'm going to put the work in, I want to get paid. I don't care about scalping and being cute with all that. There wasn't enough money in it, right? Because the way I look, scalp units are a fraction of what your normal risk unit would be. So if my normal risk unit's 100 contracts, a scalp unit is 10 contracts for me. What do I care about making nickels and dimes on 10 contracts? It's not worth the work. Plus, in futures, I have unlimited loss potential, whether I'm long or short. So it just doesn't pay for me. The expected value is too small for it to make sense. Further, not at that time, but now even if there was a big three ATR move in my favor with a scalp position, it doesn't move the needle enough for it to mean anything. It's a rounding error. It's not even, right? It's really small. So I don't want to be in the risk. I don't want to do the work, for no money. The key part is the flexibility. Some of you might also be getting alerts or be part of Discords or Telegrams and this and that. I've seen a lot of these things, and they're like, every day we're going to send you 15 of our top names. The trading engine's going to generate these things, and we're going to send you text messages for these alerts. Well, that's great. And you've heard me say, nothing against these people because they're doing hard work. They're trying to provide a valuable service. But without a plan, how do you know which one of those to take? Do you take the first one, or do you hem and haw? Right? How do you do that? And then if you're losing money and you get another signal, do you take that one, or do you blow out the one that you're losing in? Right? If you have more money in your account, you could at least put 2 or 3 names on, right? Pull the weeds, let the flowers go. Let the flowers bloom. So this is why I think if you have an underfunded account, you put yourself in a tough spot. Again, I'll give it to you that you will definitely learn the craft of trading by being in the game and learning how to trade. Absolutely. Absolutely. And if that's the goal, then by all means do it. But just realize that when you're underfunded, you start to develop what I consider bad habits. Now, a handful of people have gone on, started the same way, and eventually figured it out. But I'm going to also venture to guess that the way they're trading now with $1 million or even 500K under management is a hell of a lot different than when they did it with a couple of $1,000s. And so I just want to have a little straight talk with you, because that's really what I think I do in many ways, is be the voice of reason. It might not be what you want to hear, but I'm not putting a stick in your eye. I'm just telling you what are the realities of what are you going to face once you're in that space. Again, my hat's off to you trying to trade, but you want to have the flexibility. You don't want to have to be like, well, I have to force this trade because I only have enough money to afford the margin for the MNQs. Right? Again, that's great, but you're going to be watching every tick, which is a no-no. You're going to be probably trading your P&L, which is also a no-no. And to me, you start developing bad habits. God knows I've had them, right? I used to smoke. So again, if you develop bad habits, they're awfully difficult to break. So I would say save your money, give yourself some flexibility, have your own set of rules and not take indicators or alerts from other people. There's a couple of different types of alerts. I'll talk about that this week as well. But, you need to have a plan and say, okay, here's where I get in, here's where I get out, here's the inventory that I'm going to carry. In my case, when I was underfunded, I used to say, like, okay, if I was in a $20 stock and it went to 22 and I was risking $1, I will add that other, what did I say? I had 5K, and I would take my money and say 2,500 to futures, 2,500 to stocks. And of that 2,500s, I would put 1,250 to work right away. Whatever amount of shares I could buy, I'd put the 1,250 to work. If it went up, 5 or 10%, I would double down and increase my position by 100%. I'd double my position. I would adjust my protective stop, to where I'm risking, still $1, maybe to break even. And sometimes I get knocked out, you know what I mean? Because in the short run, things are volatile and things are very, very random. So it was very, very aggravating as well. So then I have to fight the feeling of not coming back to the market all pissed off, right? It's one thing to be an athlete and to be, motivated this way. But when you get aggravated trading and you try to take that feeling and come back and seek revenge against the market, you're going to lose. Once in a while, you might get lucky from a timing standpoint, but you need to be in optimal mental shape in order to trade. So don't take this the wrong way. Just understand that I'm giving you what the flashing yellow lights are going to be once you fund your account. Some of you, I know are already going through this, so I'm kind of preaching to the choir. The majority of my viewers are new people by a big number every episode. So that's why I speak like I've never met them before, because the majority of people I haven't. I have a lot of regular viewers. Thanks for being here. But if you're new to the show, we talk about the mental and the psychological aspects of trading, which is 80% of it. And if you've been around the block enough times, you probably know that, where you've had to look yourself in the mirror and say, what the hell am I doing? Why? I shouldn't even be in this trade. I'm losing money. I have no business being in the trade in the first place. I have countless conversations with people who are just in that spot where they're dying to trade. They're like, Mike, yeah, but Mike, I want to get involved now. And I'm like, yeah, I get it. But just understand that, especially in futures are built for institutions. The rules are built because they're hedging vehicles, right? They're not a capital asset. It's a risk transference device. So it's for hedgers. The fact that as investors, or the archaic term is speculator, you can jump in is really incidental. You just provide liquidity. But the rules aren't built for you. Institutions, they have lower margins, they get better fills, they get much more services, and that we can participate, you know, when the rules are definitely lopsided, kind of for the home team, if you will, you know, we got to really be careful about that. So think about this and, you know, mind your capital. Find ways to add. If you're working a salary job and you're making money, think about ways to add into your account to build it up. Because the more money you have, the more flexible you can be, the more trade opportunities. You don't have to worry about, like, okay, I'm in a winning trade, but I got another signal. How do I know I still don't suffer opportunity cost? You see? Anyway, if you like this video, check out this one.